All right, folks, let's take a look at a few more problems to go over. So on our next problem, let's see here, turn this guy on. Maybe I can make this a little smaller. All right, so $700,000, that's where we start out, pre-tax book income. Now we have a permanent difference, life insurance proceeds. So if you don't remember, life insurance proceeds are not taxable, so we're going to wind up subtracting that. So if you take a look right down here, we're subtracting that $20,000. And by the way, if you go look up at that chart, the one I gave you at the start of this, you'll see that that's what happens. Okay. Now, tax exceeds book by $60,000, so we have to subtract that right here. So we subtract 20, we subtract 60, and then book exceeds tax by 30,000. Another temporary difference is on warranty. Well, if you remember, the tax folks say, well, you can't take away your estimate, so we're going to have to add that back. They don't want to know about the estimate. So our total taxable income is $650,000. Okay. Now from there, our current tax expense is $136,500. Just multiply it by the 21%. Okay, this is the base tax rate. Now let's take a look at our deferred taxes that are currently happening. We have a deferred tax loss right here, 60,000 deferred tax liability, times 21 is 12,600. 30,000 by 21 is 6,300. So we had a net deferred tax liability of 6,300. Okay. Now let's take a look. We had a $3,000 deferred tax loss, and this was a deferred tax loss minus deferred tax asset gives us this deferred tax loss. So the change, 6,300, is where we need to be now. We had 3,000, so we're going to have a $3,300 expense. You add that to our base amount. Total tax provision, meaning our income tax expense, is $139,800. Okay, $139,800, and then if you look here, this is what the IRS wants. So basically, how are we paying it? We're paying this much to the IRS. This is the amount of our tax expense, and this is basically an IOU, an IOU to the tax man, deferred tax liability. And if you take the 139 over the book income, their effective tax rate was below 21%. You can see that here. Okay. So now let's go take a look. Problem number 4. Problem number 4, we start out with $520,000. Now, just like before, we have penalties. Now, remember, penalties you cannot deduct them, right? So we deducted them from our book income, but for our taxable income, they're like, no. So we got to add them back. All right. So you can see that right here. We're adding back to 12. Installment sales, tax exceed book. Now, we don't normally talk about installment sales. Let's go see what they say up top, and then let's take a look at what they say about vacation accrual. So let's go see. We had mentioned installment sales before. So let's see installment sales. So revenue recognized for tax before book, that would be the installment sales, and it says to add them. Okay. So we're going to wind up adding this back. Where are we here? Installment sales. So notice we're going to wind up adding this back, this 35,000 right here. And we have vacation accrual. Book exceeds tax by 22. Again, we accrued this, but we can't take it out for tax. So those are both going to be added. So now we're at 589. Okay, 589,000 taxable income. Multiply that by the 21% right here. You get 123,690. Now let's take a look at our deferred taxes. We had the 35,000, the first one, at 21%. That's 7,350. Then we had the second deferral. This one had to do with the vacation of 4,600. Excuse me, it's a deferred tax asset of 4,620. So we get a net deferred tax loss of $2,730. Okay, $2,730. We began with $1,000 deferred tax loss. So you take $2,730. Subtract 1,000, and it becomes a $1,730 expense. That gives us our income tax expense or total tax provision of $125,420. And here's the journal entry. This goes to the IRS. This is IOU taxes. And this is what we record from income tax expense. Take that income tax expense divided by our book income, effective tax rate of 24.12%. All right, folks, that's the second set of problems. We'll be back with the third set of problems in just a minute.